All right, good morning. How's that sound? Is that too loud? We good to go? All right, perfect. So thanks for coming to our breakout on private label ag offerings, and welcome to everybody that's joining online too. I think this is the first year where we're doing the virtual component for the breakout sessions also. So this is a fun project that we've worked on here over the last year and a half range. So I'll be talking. I'm Dave Muth. Managing partner with our investment services. They're affiliate companies of People's, where we're placing capital in agricultural land, farmland. And one of our businesses is called mAgma, right? And it's a little bit of a play on words, liquid earth, right? We're trying to bring liquidity. And really the crux of mAgma is trying to engage the retail investor market. Folks that would like exposure to the farmland asset class, the characteristics of the farmland asset class, but don't necessarily have the capability, maybe it's the resources to actually own the farmland themselves. And so Damien, I'll let him introduce himself here in just a second, but we partnered up with Security National Bank on doing a private label ag offering. Damien, do you want to give a quick introduction?
Oh, my name is Damien Howard, and I'm the Director of Wealth Management for Security National. We're a bank in Omaha with offices in family-run bank with offices in Des Moines here and also in Dallas. And I'll go through it a little bit later, but we worked with mAgma and People's Company, and we did purchase a whole farm, a fairly substantial farm, and it was well received by our investors. And we'll go through it a little bit later, but thanks for coming out.
Perfect. So first thing I want to do, and they've got me boxed in here for the virtual component, so I'm not going to be able to move around. I'll probably slide out of the camera a couple of times before we're done. Let's talk about farmland for just a second, right? And that's the whole point of the meeting. And pretty much everybody here is going to have a pretty good understanding of what farmland is and how it performs. But the bottom line, returns are incredibly competitive against other equities. This chart actually goes back to 1990 and shows if you put $1,000 into farmland, where would you be at now compared to several other sort of primary investment equities. So top line, competitive returns. It's also low volatility, right? So if we look at that standard deviation of returns on a multi-year basis, we're actually really competitive. And this chart actually lays out quite well how farmland performs in the context of high average annual returns with that low volatility. This is important right now in a time where there's a lot of angst, right? There's a lot of uncertainty about what's really going to happen in the broader economy and certainly within several investment asset classes. Okay, the other piece, the correlation with inflation is incredibly impressive, right? So this chart lays out the spread between farmland returns and inflation. And it follows and it tracks very, very closely, pretty unique in terms of investable asset classes. And I think there's a pretty consistent consensus around inflation is heading our way. We've seen it to a certain degree and would anticipate some more. Now, here's the challenge. Farmland is an asset class that is difficult to get into, and it requires a lot of expertise to manage, all right? And when we look at the diversity across the U.S., we've got a lot of different kinds of production systems in terms of the crops that are produced, in terms of how water is managed. We have a really diverse agricultural system across the entire country, and it's difficult to find deals. It transacts at a low level. About 2% annually of our $3 trillion asset class actually transacts. Right? So it's difficult to get into and it requires a lot of expertise to manage. And that's a major reason why we put the mAgma platform together. So what's been happening? Incredible run, particularly over the last year in terms of values. Here's values by region across the country. And for folks that are interested in looking into this a little bit more, the 2021 National Farmland Values Report from People's Companies, downloadable at the website. This is a chart that's pulled out of there. That'll describe a little bit of what's been going on in different regions and some of the backdrop on some of these numbers. I would encourage folks to take a peek at that. we pretty consistently see this bump where the trend flattened out and then has popped up quite a bit going into 2021. The reality of the data behind this is it's a little bit aged. It's using USDA data from about the middle of the year, and there's actually been a bigger bump than what you necessarily see in this chart. So here's the farmland values by state, again going back to the same USDA data. So we see differences across the country certainly, and looking at this increase on a percentage basis really paints an interesting picture. And this is really focused on cropland, but it's gone up, right? And so if you take this August 2021 change, and it's somewhere between double and triple on a state-by-state basis is where we're seeing it actually landed in terms of the bump. So the asset class has seen a major run. It's a lot of these characteristics that we went through in terms of financial stability, competitive returns, inflation hedge, interest from outside capital is really shot up. And then we've also seen a lot of transactional volume. Other piece that's important in there is certainly low cost of capital from a debt standpoint. All right, so I want to talk just briefly about mAgma. So what we've built out with mAgma is the ability to acquire an asset and then have fractional ownership down to a level that's as small as about $5,000. That entry point can change a little bit asset by asset, but we set up a single purpose vehicle, and the investors are effectively buying shares of the trust and now of the entity, that vehicle, and all of the distributions in the standard farmland return profile comes back to the investors. We're typically on a fixed hold period. That hold period can vary a little bit. The general partner in the structure can have some discretion around dispositions if there's some opportunistic kinds of outcomes that would jump up. And it's really interesting in the context of a vehicle to get folks that want that characteristic, that set of characteristics from a farmland investment engaged in the asset when they may not be able to take it down on their own. And this market's growing right now. There's several competitors out there to mAgma that are working in similar models and seeing a lot of the same trends. All right, so one of the really important things, and I talked about how farmland's difficult to get into, the partnership with People's Company and that broad national footprint, right? Boots on the ground, identifying and working transactions across the major agricultural regions in the country, that's what creates our deal flow. That creates our ability to find deals that can fit this mAgma sort of profile really well and be able to get folks started. Okay, I'm going to turn it over to Damien to talk a little bit about B.
Thank you. Okay. Like I said, we are an Omaha-based bank, small bank, $1.5 billion in assets, with offices in Des Moines. We've been in Des Moines for about 6-7 years and recently entered Dallas. I'm the director of wealth management, which means I'm the chief investment officer for wealth management. We have about $1.6 billion in assets under management, some of farmland, some private, and about $1 billion of security, equity security. Dave talked about the investment structure, but you want to?
Sure.
Since you set it up.
You bet. So this is a pictorial view of how we actually put these structures together, right? So you've got that single purpose vehicle that is acquiring the asset. We've got professional farm management through People's Company. So that component of making the asset work is taken care of. And then in most cases, in really all cases in a mAgma asset, we're going to have a partnership with a farmer through a tenant lease kind of arrangement. We often like to stack in some upside, right, with some flex terms, sharing the profit with the farmer. And there's some scenarios, particularly when we get into more specialty type crops in other regions, where how we set that up can actually create some real upside for the investment entity. And then the mAgma is the general partner on the SPV, and the investors come in buying those shares. The process is set up to streamline getting investors in, right? This is where we've created a fully digital workflow that's enabling folks to literally get invested from the website. Now, there's a lot of steps, right? There's various regulations behind this, a lot of checks. We've got to do accreditation checks. We've got to do the know your customer checks. We've got a number of security checks that are required within our regulatory environment to make this work. And we've got folks that can certainly help people work through it. But the website and then the supporting applications behind the website are a fully digitized platform by which you can sit at home and get yourself into farmland as an investment. And that's been quite a bit of work to get that set up and structured.
All right. Here's a picture of our farm. Currently it's under CRP. And last July there was a big fire out there. About 10,000 acres burnt, but a lot of it of our farm burnt. And I like this investment because it's one of the few investments, if it burns to the ground, it goes up in value. So our farm burned to the ground, we're going to have to pay less to bring it out of CRP. Unfortunately, here's some of the old homestead buildings here. The fire department didn't call me, and they put the fire out before it burnt down. These are scheduled for demolition next year, or this year. So they should have called me. I'd said put it down, but they stopped the 10,000 acre fire right there. So, why did we do this? This is a farm in Washington State. We're in Omaha, in Des Moines. In the spring of last year and the fall of the previous year, we got worried about inflation. We did a lot of portfolio moves to reduce our inflation risk in our portfolios and reduce the risk of rising rates. And one of these we looked at is farmland. So we looked at some REITs, the farmland REITs. We looked at other things, and I don't like leverage, a lot of leverage at all. And so we didn't like the REITs. They provide a lot of leverage, and we wanted a little bit more control. Plus, a lot of my investors, a lot of my clients already have farmland in Iowa and Nebraska, so we tried to do something different. So we looked at farmland. We came across this farm in Walla Walla, Washington, been under CRP. It was a century farm, owned by the original Homestead family that were there about 100 years, a little over 110 years. It hadn't been farmed for a while. It's 3,000 acres. It's hilly there. It's not flat Iowa land. It's hilly. We've got 2,800 of tillable. It will be going. It's under CRP this year. It goes into production next year. And there it's a winter wheat where you rotate fallow one year and wheat the next year. So you only farm half the farm each year. Let's see. So we're going to bring it back in. I've already met the farmer, talked to him. We're going to bring it back in, bring it into production. So as we bring it back into production, we'll look at liquidating it as we get a couple of cycles, get this land producing for the farm. One thing we looked at the inflation hedge. Again, like you've heard all the time, we did this research. That's the reason we got into it, inflation hedge. I wanted no leverage in this transaction. Most of our investors are already fairly wealthy. You have to be an accredited investor to be in it. And we wanted a safe, simple story. You can't go broke if you don't, can't go bankrupt if you don't owe anybody money. We got no leverage, 100% cash. That limits my downside. I can take my risk bucket and put it more into equities where we're getting some fairly substantial returns. So no capital calls. It's just dirt. So we're going to tear down the buildings. We'll have couple of small grain storage areas. So no capital calls, just dirt. Current income. We're going to get about 4% annual yield going to our clients and stuff. That beats bonds. Whenever we did this, the 10-year was yielding about 80 basis points. So a 4% yield versus 80 basis points looks pretty good. In the first 2 years, the cash comes from the U.S. government anyway. We work with mAgma. I renegotiated some of the fees, also put in some incentive compensation. So if our annual yield is above a certain percent, they share in it. If we get it, when we sell it, when we do wrap it up, if the return is above a certain percent, they share in it too. So we have incentive compensations. I reduce their front end yield fees for maybe greater incentive compensation at the end. Flexible duration. It's between 7 and 10 years. We can decide when we want to sell it. We also set up an advisory committee. We advise the general partner on how things go, the annual budget, and the ultimate sale. You know, when it's a cash rent, nope. Since it was CRP, it was the family's long gone. Even some of the family was in Argentina, so it's a clean break from the old family. No, that just happens. The fire is just incidental. It just means that when it comes out of CRP, we don't have to spend as much on herbicides and things like that. The entire farm will come out of CRP in the fall. So this land was not in production for roughly 20 years. You could, however, this type of farming does not lend itself to organic because you have the 1-year fallow. And it would just cost way too much to control the weeds in that 1-year fallow. The land there only gets about 13 inches of rain a year.
On this.
So it's a dry wheat. The Palouse in Washington State, it's been wheat since they've settled it about 120 years ago. Dry land farming, even though we're only about a mile from the Snake River. So, the grain comes off the farm, goes about a mile to Snake River depot, grain collection, so it's fairly efficient there. We set this up, it was exclusive to our clients. We have about 550 clients, about 800 accounts, accredited investors. Everything ran through us. We did all the sign-ups because they're all discretionary accounts. We have discretionary control. Since we're an OCC governed account, we don't go through the SEC. We go through the OCC. We have been through a compliance check, regulatory review. They've reviewed it. They were happy with the way we did it. So we're good there. Repeatable structure. We plan on doing another round sometime this year, maybe next year. My goal is to have one coming off every year or two. So that means I have to keep putting one on. It is part of our asset allocation strategy. We have asset allocation, in our asset allocation, an allocation to hard assets. There we have infrastructure funds and some other hard assets, and this is part of our hard asset strategy, kind of inflation protection. Again, I'm not a farmer, so we are using mAgma and People's Company. They're coming to us. They're providing the expertise, and we're paying them a little less than they'd like, but more than I'd like to pay them. But we are sharing in the upside too. Annual valuations is important. We're not quite a year old, but we have an appraisal that we did last summer. We will do an appraisal every year. So we do have clients, and they do die. And there are some liquidity concerns. If the heirs do not want to take it, or if it goes to charity, we have to have liquidity to it. So we're kind of making the market. So we get monthly financials and a monthly NAV. Every year we will reappraise it and mark it to appraisal. So we'll have a fairly current fair market value. So next year when the appraisal comes in, if it goes up, hopefully, then we'll trade it at that level. So we've got commitments from some investors in the company that, if some units come available, they will buy it at fair market value. So our investors can get out if they need to prior to the sell at NAV, net asset value. We're in a cash rent agreement, so simple cash, simple to understand, just dirt, just money coming in, and we'll sell it. We are bringing some land back into perspective. And, most of our clients are either 1, 2 generations away from the farm. So this is a way, I did a $20,000 minimum. This is a way for them to own some farmland, get some appraisal. And we also have some investors that already own $5 or $6 million farms. They're coming into it because it's also a diversification. They own some cattle ranches in Nebraska, some farms in Iowa, farms in Kansas. They're coming into this deal because there's a diversification of farm in Washington State. And then also, one good thing, mAgma, they're doing the K1. They promised a K1 in February. We've got some private investments that you don't get the K1 till October. Nothing pisses my investors off. They call me February 1st, where's my tax numbers? We don't get them out that soon because we have mutual funds that don't report. So we're usually February 20th. And that gets people mad. They want to do their tax. I have investors who want to do their taxes January 2. So we'll get early K1s, early reporting. So that's one reason we looked at a lot of alternatives. And the reason we have don't do it is because those late K1s. Everybody, we have people who still file extensions that get mad if the K1 comes in. And they're going to file an extension anyways. Late K1s are a big source of frustration for all investors. So early K1, that's what we're looking for. So our offering, the offering was $2.2 million. Bought the farm a little bit less. We have some cash reserves to tear down some buildings, and just to have some cash reserves, just because we're a little conservative, and also underwriting cost. We have 60 investors of our clients, well oversubscribed. We were an allocation basis, so minimum 20,000. But a lot of people put in more. If you put in 200,000 allocation, you got 120,000. So fair allocation. That also creates demand for when we have liquidity events. There are people who did not get their full allocation that said, yeah, if something comes up, I'll buy it. It's going to be an NAV. We already had our first payment. They were happy about that. And then our plan is, we've entered into a long-term lease, a cash rent with a young farmer, going to bring that into production, bring it back up, and then we'll liquidate this in 7 to 10 years. So, but in the meantime, we will supplement it with additional offerings and follow-ons. So, any questions? Okay, sorry. Well, according to the guy upstairs, we're going to be in a recession at that time. So no, it depends on the market. The market at that time. The reason I say that is we'll have 2 cycles. Because you only do half the farm, so we'll have 2 cycles, and you'll have some better. The first year out of CRP is not the best productive, so we'll have a couple of good ideas of how productive the farm will be. And of course, it's under their management. They're going to improve the soil and keep it some of the best farm in the county. Based on the price of wheat. Yep.
Yeah, so all of the people's company managed assets are enrolled in the Leading Harvest Sustainability certification process, and this farm will also go through that. So it will be third-party audited along with the rest of the portfolio of managed assets to get that certification. Short answer, yes. All externality valuation opportunities are on the table with the way the asset's set up and structured. It's all on the table. mAgma. mAgma has 5 offerings to date. A couple of Iowa offerings, one in Oregon, one in Washington here, and then another offering that's coming live in the Delta region.
But each deal would be one farm.
Yeah.
So it'd be it's a single purpose vehicle, so a single farm per kind of transaction. So if we do another transaction, it'd be another farm.
So in this structure, in this SPV structure, we've gone through all the legal checks, and it's not a problem for us.
One of the nice things, too, about this is Washington has no state income tax, so it's not subjecting our investors to Washington income tax. And a lot of them are held in tax-deferred IRAs, so we don't have to worry about that anyway. Not bank capital. We haven't had it yet, but there's one coming up that we have. You know, we have investors who have already expressed interest, and we're going to formalize this soon. It will be, you know, for instance, if someone dies and they say we have $50,000 or 5 units that come available, we will send an email out to all the investors and say we have 5 units available. The NAV is $5,000. Are you interested? And if we get more than that amount in, then we'll have a random drawing or just a fair allocation. And if there is no level of interest coming in, we have a couple of investors who said they will backstop that. It's only mine. And it is set up that if an heir wants it and doesn't want to stay my client, they can keep it, and there's nothing in the agreement that said they have to be my clients. But right now it is still controlled within the client. And for that, though, we have an advisory board. I get the financials, review it. Now, there's not a lot that happens in the financials. It's just dirt. And we get paid once a year, so. It does not.
Yeah, so that's dictated through the standard people's company lease format, right? And so there is absolutely collaboration around how that will work, and there is some level of oversight. Typically, there's not going to be we're not going to dictate the crop choice. On this particular farm, it's pretty clean choice. There's not a lot of optionality.
Wheat and rapeseed's kind of the only thing that I grow there.
Yep, but the lease structure does create oversight and requirements, and fundamentally creates the ability to get out of a lease by which a tenant is not adhering to any number of various reporting or execution standards. No, I mean, it's still a tenant relationship, right? So the tenant has the ability to make decisions about how it's managed within the structure of reporting and the sustainability requirements, et cetera. But if it's deemed that the tenant is not meeting any of the set of standards by which the lease requires from just an overall outcome basis, then that would be terms by which that lease could be canceled, terminated. So the short answer is no. I mean, it's a standard tenant relationship. It's not you will do X and Y on acre X and Y.
Yeah, all of our accounts, we have some exceptions, are all 100% discretionary. But we went through this case. We only did accept accredited investors, and pretty well almost all my investors are accredited. That you pretty well have to be in order to afford my fees. So we did solicit all the accounts. Some accounts, if we're the trustee on, we're soliciting ourselves. But I did go through and solicit. We have frequent communications with our, I sent out an email, a marketing piece to them. And we did go above and beyond. There's no account that people were surprised to see it. And that was, to get the buy-in and stuff. Because, I still run a collaborative, even though I have full discretion. Nothing is black box and stuff. And, this is a small part of their portfolios. Very few portfolios is any allocation above 1%. In my hard asset allocations around 3 to 5%. So I kind of built it where I can add one a year or every other year or something like that. So the goal is, and that should be the goal with any alternative, is to investments that are private equity or anything else. You have to commit to a program of 5 to 7 years where you do a little bit each 5 to 7 years, so you have that cash flow going. So we're just at the start of it. We haven't gone through a K1 season yet, so still fingers crossed that everything goes well. And if everything goes well in that and we have a good appraisal, we'll do another one. And if an heir doesn't decide to stay with us, they can take that with them and stuff too, because it should be a decent cash flow. Even with rising rates, a 4% annual unlevered yield is still a pretty good yield.
Another question?
Yeah, that's net of fees, and that's not, it's annual yield. We project when we sell it, we should get a kicker. So we get 4% after fees, after property taxes, after insurance, after everything to our investors. There's some management fees, too much.
It's on a per acre basis, and it's quite low. I'd have to go actually look back to the agreement to see what it is, but it's quite low. It's a very small percentage.
Yeah. We're target appreciation's 5%. And that also includes taking it from unproductive land to production and stuff and selling it then. And then that you know, our goal it was pretty modest. It's just a 7% all-in IRR after the 5-7 years. So pretty modest, but that's unlevered. And we do that as an inflation hedge, and we take a lot more risk in our equity portfolio, which we've been getting in the 30s for the last 7 years.
In general, we underwrite assets on an appreciation basis based on USDA data, average annual appreciation for each state, based on a 20-year basis. That's the general underwriting criteria.
Well, we've only done one, and this one was, you know, ideally, I would have done a smaller farm in order so I can keep buying more. You know, eventually that pot of money is my allocation is gonna get full. But my guess is I'll probably want the next one $500,000 to $1 million range, and that's and unlevered. I might put 10% leverage in, but I still want to get my investors a pretty hefty annual coupon. So that's the bucket that I have hard assets in, is a yielding bucket that goes up with inflation. So I still, you know, if I add leverage, it's going to be a small amount of leverage because I still want, you know, when I do it, I want at least 200 basis points above the then treasury. So if treasury's 2% when I do it, I'll want a 4% yield. Livestock's kind of a little too complicated for what I'm trying to do. But I would rather also go organic. So that's kind of the next, if I had my druthers, it'd be 750,000 organic farm. And I also want some geographic diversification. They brought me a bunch, but I also, most of our clients are Midwest. And so we have Nebraska farms in our accounts, Iowa farms they have. And so this provided diversification. I don't know if any of my clients has wheat farms. We have some that have Kansas, but they're ranches. So it provided just diversification. It was a farm that was coming up. You know, and it's cheap there. I mean, that ground is, I bought it for 850 tillable acres. So it's pretty easy to get a yield when you only pay that. Right. Well, that's if I want to do another private label. I can also go in some of the other ones. But I have less power to talk down the fees if I go in with other people.
The asset pipeline is surprisingly diverse, right? So, you know, buying farmland right now is tricky because you got to pay a lot, right? And you start talking about an Iowa deal hitting a 4% net coupon.
I can't do that.
Pretty tough, even unlevered. And you might not feel good about what you've put on paper if you actually see that, right, with the reality of what it's doing. But, you know, so we work really hard with that sort of national footprint on drumming up deals. And, you know, it's still a small percentage of what you see that you actually can get to work within a structure and meet all the metrics. But there's more of them in that, let's call it million plus or minus range in these diverse geographic regions than what naturally sort of comes to your mind when you spend a lot of time digging.
It's SPV, it's a single purpose vehicle that has the title. And they're the general partner, we're the limited partner, so in theory we have no say on anything.
That's a great question, and it's a complicated question to a certain degree too. One thing to be clear is mAgma and our investment businesses, we call them affiliates, right? We've got a firewall because the transaction side of people's company needs to maintain its focus on the transaction side. The investment companies, with that partnership, we can leverage that boots on the ground and that deal flow, right? Always deal flow in farmland is such a big deal. The general sort of crowdfunding fractional ownership model, it's absolutely going to have an impact. And we're already seeing it, right? There's deals that we've lost from multiple ends of the transactional spectrum to some of these competitors that are out there, they're working in it. By and large, I think that's probably a fairly sort of slow trajectory in terms of transitioning the asset class to a little bit more institutionalized type of asset class. A net outcome over some undefined period of time is absolutely that full institutionalization of farmland. That is our perspective. It is, and you've been seeing it happen at sort of trickles, particularly in certain regions, right? You get out into the Pacific West and you're talking about generally vertically integrated institutional types of folks in a lot of those sorts of production systems. And as we move forward, the demographics lend themselves to accelerating transaction volume. The economic realities and characteristics of farmland lend themselves to increasing check size associated with purchase. And then when you start to underpin all of this with ubiquitous data around ownership, around management, around opportunities, around markets, and create vehicles and business models like mAgma, like its competitors, that allow that broader base of capital to get engaged in the asset class, those things combine to where that machine is going to kind of continue to move in that region and in that direction. And at the end of the day, I think it's a good thing, right? Because it creates more value and more capital into our asset class. And I'm a farmer in north central Iowa. I get it. I talk to my dad about some of these sorts of things. It's not such a happy sort of feel-good sort of story. But as long as the right objectives are put in place, this extra capitalization in the asset class and more efficient capitalization in the asset class will be of benefit, generally speaking, to farmland.
The way I look at it is, you know, as a farmer, as the entrepreneur, for this asset class, my required return is fairly low because the bucket that it has in my asset allocation. I'm really only looking for a 7 to 10% return on capital. Now, an entrepreneur should be getting 25% return on capital. So a farmer should not be tying up his money in land. He should be tying it up in equipment and expertise and all the other things. Because, you know, an entrepreneur should be getting 15, 25% return on capital. You can't get it, and you shouldn't get it on land. That asset class, I only need to get 7 to 9% on that asset class, because that's the bucket that it goes in my asset allocation. So it's from my perspective, it's a more efficient allocation of capital. The farmer should put the capital in equipment and expertise and software and managing the farm, much like, you know, a commercial building and stuff. Most people don't own the commercial building that they're in because the return on that capital is too low for an entrepreneur. An entrepreneur should be paid more on their capital, on their money capital and sweat capital than what they can get on farmland.
Excellent. Well, I guess if no other questions, thank you all for coming to our breakout.
Thank you.